One of the indicators we use to guide geographic positioning within our own portfolios is a metric we term relative market implied returns. This measure derives a forecast rate of return, or IRR, for in this case market indices, which encompasses three elements. The first is a long-term earnings growth rate, using market consensus figures, but assuming they revert back to long-run averages. The second element assumes that these earnings are valued on a multiple which also reverts back to the long-term average, whether that be upwards or downwards at any particular point in time. And the third is the starting income yield. Whilst clearly many other factors can and should be considered, the reason why I like the market implied return is that it is long-term looking. It incorporates both growth and value into the analysis, rather than simply one or the other. And it also enables the ability to compare and contrast differing regional markets, irrespective of the structurally different growth rates and drivers. The UK market, and specifically the UK small cap and UK mid cap elements of the market, continue to screen well on this measure, relative to almost all other major broad developed and emerging regions. It is therefore no coincidence that a disproportionate number of the guests we have invited to join us on the first 40 episodes of the Investor Insights series this year have been stewards of UK equity investment mandates, of a variety of investment styles and fund structures, of course. In this week's episode, we were delighted to be joined by the hugely experienced Gervais Williams from Premier Miton. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website killick.com. In this week's episode, we were joined by Gervais Williams, who joined Premier Miton in 2011, but whose career extends over 30 years, including 17 at Gartmore, where he was head of UK smaller companies. In his current role, Gervais is head of equities and manages a number of open-ended funds, as well as the London-listed investment company Diverse Income Trust, ticker DIVI, or DIVI for short. DIVI aims for both an attractive and growing dividend alongside capital growth, from a strategy which has the ability to invest across UK equity markets, but which typically has a bias towards small and mid-sized companies. The listed fund structure enables Gervais and his co-manager Martin Turner a high degree of flexibility to navigate markets, including the ability to use modest hedging strategies, which have been implemented to good effect since its launch in 2011. Shareholders of the trust also benefit from an annual redemption facility, enabling the ability to exit and helping to limit share price discount volatility in periods of stress. Despite this feature, at the time of recording, the shares trade on a circa 9% discount in what is another example of the depressed valuations on which much of the UK investment trust sector currently trades. This was a typically insightful discussion with Gervais, who always has a well-considered take on current investment markets. We hope you enjoy the episode, and as always, please get in touch should you have any questions or require further explanation on any of the points raised. Gervais, good afternoon. Thank you so much for joining us. How are you doing today?
I'm doing really well, actually, Gordon. I'm really quite looking forward to this conversation.
Yeah, good stuff. So, Gervais, we've got this kind of standard opening question. We really should maybe try and think of a new one, perhaps for next year. But what we've been asking is a question to try and get a bit of an insight into kind of you and how you go about your work. Really, I wondered if there was is there a kind of an anecdote from a recent meeting that you've had, or kind of research project, or even just an article or a book? We've had some book recommendations in this slot. Anything that you could share?
Yeah, I mean, well, I like the question, actually, and I don't think you need to change it very much, because even asking the same person this question sort of, 3 years or 3 months different, you'll probably get a different answer, which is good. I think one of the areas which I find most interesting is, I think when you make presentations up, I make a lot of presentations. I actually find the whole process of not just putting the slide together, but thinking about the issues I'm talking about, can sometimes lead to inquiry and insight. So I've been looking really at just how dominated the market's become by transactional strategies, the Magnificent Seven, Bitcoin, whatever. And the nightmare with those kinds of strategies is you need to buy well and you need to sell well to generate the return. They're very, very transactionally orientated. And really, with ETFs and all the other things, really the whole of the financial world, particularly even professional fund management, has become very dominated by transactional strategies. And that works beautifully when markets are rising and all the rest of it. The nightmare with transactional strategies is that you can become crowded on the way in. Note some of the rising share prices of some of the popular stocks at the moment, or indeed crowded on the exits. Complete nightmare. And so I was looking at that relative to good and growing income. Good and growing income, it's kind of slow moving. It's the tortoise, not the hare, and all the rest of it. But the wonderful thing about income is it doesn't really rely on markets going up every year. Sometimes they go up, sometimes they go down. But most particularly, you get your income every year. And you never get negative income. So it's not like you get a good big year and then a negative year like you get with capital gains. Actually, it's all related to, you have, reasonable income, and hopefully without the income being cut, you get another income the following year and the year after. And, if it grows over time, that can become very dominant. And thrillingly, from my point of view, the insight bit is actually, I think that you don't rely on good transactions to make return. Indeed, if you find that you don't need the income because you're independently wealthy, so from that point of view, you can actually then use the income to buy more assets at times when the share prices might be depressed, the markets may be upset about something, and actually you can enhance your upside by buying distressed assets with income at even higher yields and see those recover. So going back to it, I think that most investors are not putting enough attention on good and growing income as a method of generating return compared with capital appreciation and transactional strategies.
Yeah, no, absolutely. Yeah, the compounding of a growing yield can have a huge impact. I'm sure we'll come back to income investing. A later question, I'm sure we'll circle back to that. But we've had a little bit of time at least to digest the first Labour budget. And I wondered if we could dive straight in on some of your thoughts there. I mean, in relation to UK investment markets, I wondered whether you could kind of summarize your thoughts on we've had changes with inheritance tax, and which kind of has implications on the AIM market, and also employer national insurance rates on kind of more domestic UK companies. I wondered if I could, I know it's kind of a big topic and there was lots going on. Could I ask you to maybe summarize your thoughts on kind of what you see as the big impact there?
Yeah, I mean, overall, the last 30 years, particularly in the last 5 and 10 years, the best performing stocks have often been big companies. You think of the mega cap holdings there, the largest stock market, US versus global stock markets, etc. So it's already been about bigness. Smallness has been somewhat out of fashion over recent years. And really, we need a healthy small cap market because that's the foundation of successful big caps. ARM came from being a small cap, Apple was once a small company as well. So coming back to it, I think, the one thing I hope, with the government is that we are going to get more interest in smaller quoted companies. If we go back to the budget, if we go back to the Mansion House speech, in both cases, I think they slightly missed the target. If I was being critical, they sort of had a slightly open goal, which they could have gone, that they somehow missed it. So specifically, private companies, no problem, support private companies, more private companies coming through to markets, very good. AIM market, yes, it's got inheritance tax relief, and then imposing inheritance tax on AIM stocks, albeit at half the rate rather than the same rate as pension assets. It's a nod in the right direction, but it just fails to meet the agenda, which is that we need a vibrant quoted market for all the unquoted companies and all the other parts of the ecosystem to work. And I'm just disappointed. Bizarrely, I don't think it's going to necessarily make a big difference long term. It could have made a big difference, but I don't think it is. I think the pension reforms, we've got Emma Reynolds reforms coming at the end of this year. I'm rather hoping she's going to mandate at least some part of our stakeholder pensions hopefully some part of local insurance companies are mandated to invest in UK quoting companies. Quoting is the key word there. And that will include big companies, but particularly small companies potentially as well. And I think that would be a wonderful outcome. But up to now, I think they've missed the target, is my summary of the view.
Gervais, you've mentioned in already in some of your answers, you kind of mentioned the kind of the concentration in the Magnificent Seven and some of the kind of laggards in the small cap world. I was particularly taken by reading some of your kind of recent commentary, talking about this potential change of market leadership that you see coming, whether it's a case of kind of a less benign inflationary environment or some of these big global trends that are going on, kind of globalization fading and some of these protectionism policy coming into play. So I wondered if I could ask you to kind of talk through some of the key aspects of that view for our audience, if I may.
Yes, I mean, I think language is wonderful because it does give just an inkling of what people are thinking, even if it's sometimes unintentional. So we look back to the last, 20, 30 years, the globalization trend. Many professional investors, many private investors talk about it being a sort of Goldilocks environment. Well, we all know that Goldilocks didn't exist, right? So our whole kind of insight to where we think the markets are being driven by things which aren't perhaps as firm as we all would like. Specifically, that doesn't mean that, major companies can't go up further. The US stock market might go up further. I'm not saying that's that. I don't know quite what's going to happen right now. But what I can say is that actually we've gone through a sea change in politics. I mean, even 10 years ago with Brexit, the first election of Trump, etc., I think we were already looking at a pattern change coming. I think with the compromises that would come with globalization, particularly exposed during the pandemic and obviously with the Ukrainian war, I think the electorate's willingness to accept the compromises that come with globalization have become more intolerant, and we've got a lot of nationalistic policies being advocated by politicians. You've got the Trump election with the protectionist agenda as well. So basically, I see a sea change in politics coming through. And I think we're going to see an equally significant sea change in market trends. Interestingly enough, we haven't really seen that up to now. And you would have thought that market trends would have been moving ahead of rather than after all this. But for whatever reason, we can argue why that hasn't happened. But right now, we have got this position where we've got a lot of concentration of institutional capital into a relatively narrow band of very large stock-specific risks. A very narrow band of corporates which have technology at their core and therefore might move in correlation with each other. And specifically, in many cases, have risen to valuations which to the casual observer look very forward-looking. So kind of we're in a sort of slightly dangerous waters where any change of market pattern might be associated with quite a not just a change, not just the ability to lose money in some of these crowded trades, but most particularly for the pattern change to lead to a very sustained and long, a change which lasts for many, many years, possibly many decades. That's if I'm right about that, it's a big if, and it's quite a it's quite a bold thing to talk about. Then the advantages of moving early are disproportionate. And what is the opposite of mega caps and technology and capital growth? Well, of course, it's income, it's small caps, it's companies which are generating good and growing income, albeit they may not grow as fast as the mainstream companies. So coming back to that, bizarrely, it's the UK market. Actually, we may not realize it, but we're sitting on a gold mine. Right? And so my view is actually the UK market doesn't just keep up with the US, it outperforms small companies. Obviously, UK is very, very dominant in not just in mainstream companies, but particularly small caps in the UK. And we have small and micro cap companies, which are different from the mid caps in international markets, which I think are well positioned. So my own view is actually, if I'm right about the future, big if, then actually the UK isn't just superbly positioned, but many of the small quoted companies won't just gather increasing support, but actually they'll be in a position to take huge advantage of the changing pattern, accelerate the earnings growth through acquiring assets from receiver and such like, and actually deliver surprisingly strong outperformance, not related to our UK economy. Our UK economy is no better than anyone else. Not related to our politics. Our politics may be stable, but I don't think it's a lot better than most other people's. But just to difference. I think too many people have put too much capital into capital growth, mega caps, and there's too little capital in good and growing income, and specifically small caps. And I think that pattern change could be terrifically good news for many local companies.
Yeah, when you're talking here, you're talking about the kind of unique biases that the UK listed market has with the kind of types of sectors that we've got big exposure to here in the UK. It's not just the small cap effect; it's also kind of sector biases.
Yes, I mean, the key issue, which sounds rather perverse, is that actually most of the UK major companies are dominated, will invest in capital-intensive industries.
Yeah, yeah,
It's going to say, why on earth, if we're entering this period of change, if we're entering inflation or deflation, if we're entering more lumpy currency movements and interest rate moves, why on earth would you be wanting to buy capital-intensive businesses? And that's because actually in the last 30 years, as the cost of credit has come down, if you happen to get lucky in a capital-intensive industry, a specialist sector perhaps, then it's been easier and easier for people to compete with you. They've been able to raise cash and put capital in and dilute your return. As you find the cost of capital moves up, as the cost of credit moves up, as credit providers become more discerning than they are now, then effectively those with established capital already invested mean that there's just less competition going forward. And if they happen to be in the right place at the right time, they don't just make a disproportionate return, but there's not much new competition comes on stream, and therefore they don't just make an unusually strong return, but they make an unusually strong return for quite a long period. And so I think that's the thing which I think will catch people out.
yeah. I suppose let's maybe move on to the portfolio itself. And I mean, just given the kind of backdrop that you've just kind of laid out, I mean, could you maybe just talk us through and kind of summarize the kind of key exposures that you have there? Obviously, the divvy strategy can invest right up and down the UK market, whether it right from small up to kind of large cap. It's got a real flexibility there. Could I ask you maybe just some of the kind of key exposures as you see it when you're kind of looking at the portfolio as a whole? What are the kind of main themes and kind of areas you're positioned towards?
Yeah, I mean, one of the features of fund management generally is that most investors, most professional investors, they find financials it's a bit of a difficult sector. There's lots of them, and they're complicated, and when they disappoint disproportionately and all that kind of stuff. But actually, there are quite a lot of capital-intensive industries, companies operating in the financial sector. And so we find it's a sector which actually is valuations, expectations are low. When companies succeed in this area, you can get very attractive returns. And so ever since we set up the Diverse Income Trust, actually, it's always been a larger sector. It still is a larger sector. It's not just financials. There's lots of subsectors in there. We've got things like TPI cap, which is involved in the facilitating the ability to buy and sell government bonds. We've got PayPoint in there, which is a company which is involved in terminals on corner shops. We've got CMC Markets, which is involved in helping companies to become more effective at offering dealing services to their customers, and the XPS, which is involved in pension schemes, and particularly how professional pension schemes manage the risk. Of course, it's got mainstream companies, we've got some life insurance companies in there, we've got some car insurance companies in there, but most particularly, it's a very varied sector. It's always been the dominant sector. It's been as much as 40% in the past. It's 34% at the moment. But that continues to be a cornerstone of the industry and the portfolio. But the second largest is perhaps a little more surprising, which is materials. Don't get me wrong, we are interested in mining companies. There are companies which are in the material sector which aren't mining companies. You might get in things like soap homes and Ibstock, which is a brick manufacturer. But most particularly, it's really dominated by many companies which are gold mining companies. And the reason we like gold mining companies is it's just very uncorrelated to economic growth. And when adverse events, geopolitical adverse events happen, sometimes, as we saw with the pandemic, gold price can go up a long way. So something like a Pan-African Resources, which is a gold mine in South Africa, has been a terrific performer for the fund. Greatland Gold's a recent entry. So coming back to it, there are quite a few mining companies which we think might produce some very attractive returns. Certainly, we think the risk-reward ratio is misunderstood by many fund managers, or people don't invest because they don't know what the gold price is. I don't know what the gold price is. I just know it's less correlated. Third largest is energy. Again, probably a surprising selection. The UK is quite large in energy, but we think actually, despite climate change, and we're very strong advocates that basically we do need to reduce carbon intensity. Specifically, we think that by investing in companies which are moving ahead of others and being effective in that role in the public arena, we think that we can invest in companies. And the energy price, a bit like the gold price, could go anywhere. But I don't know what the oil price is going to be. I don't know what the gas price is going to be, but it could be spiky either way. And so we again feel that. And then you've got some industrials. What we haven't got is many consumer stocks. What we haven't got is many large ticket items. What we haven't got is many of those kinds of stocks which are reliant on bond yields being low and lower, the sort of bond proxies as they're called. So the portfolio is actually, it's quite extensive. It's got a vast number of risks, but they are largely, and we are viewed largely uncorrelated. And that's why the overall volatility of the fund is relatively low, but most particularly, the added value, the scope for added value, the stock selection can add plenty of, not just good and growing income on top, but particularly capital appreciation as well over the longer term.
Yeah. Jumping around a bit, apologies for that, but I mean, I appreciate you're very much focused on UK listed companies, but I mean, going through that list, I mean, it's not dependent on the UK economy. I mean, we were talking about global businesses in some of these instances, and just the US elections just taking so many of the headlines at the moment for good reason. I wondered if that election result has implications for your portfolio and in the UK market. Are there things that you're particularly considering at the moment with regards to the portfolio? I appreciate the policy isn't kind of firm yet, but the kind of rhetoric that Trump's coming up with at the moment.
Yes, I mean, in a way, as I sort of implied in an earlier answer to an earlier question, we've got this kind of this Goldilocks trend, which is very aged and stretched at the moment. So in a way, we don't need more of the same. We do need change. I'm not a great advocate of Trump. I think he's a bully. I think he's dishonest. But I think the agenda he talks to is actually more in line with the electorate than many of the other politicians out there. So actually, I'm not surprised he got a clean sweep. And actually, I think the implications are that we will get a pattern change in terms of the policies and the economic leadership of the stock market. But specifically, I think it'll also be associated with all sorts of volatility, extra volatility. So that means particularly currencies. I think currencies which have gone up and down in the past, I think you could actually get much more extreme movements of currencies. Specifically, I have been worried for some years now that quite a lot of the smaller countries, perhaps in Africa or Asia, possibly in South America, will actually run out of hard currency in the way they did in the 70s. Haven't done so. Don't get me wrong, Argentina and Turkey have done so recently, but generally most haven't. And I think that's going to become a significant feature. You can have a very successful project, perhaps a mining project, operating in a relatively small country, and they just run out of hard currency, and they say, well, can you have some local currency instead? And actually, that's a big disappointment when that happens, right? So it's already changed our behavior there. I think we're going to get an equal kind of variance in terms of deflation or inflation. We're already seeing deflationary pressures in particularly China, Europe, particularly Germany. I think some of those may widen in future. Deflation comes at a time when profit margins are very high, so there's a real people do hold back on buying things because they're potentially cheaper. Then you get real margin squeeze. I think we're going to get a lot of corporate margin squeezes. On the other hand, inflation, we might get more inflation in the US. I don't know. And if we do, clearly then passing cost increases may become more difficult into a relatively price sensitive electorate. And if that happens, of course, that also equals to profit margins. So overall, I do expect global profit margins to come under pressure. I expect markets to be more volatile. I expect currencies to be more volatile. I expect events, i.e. inflation and deflation, to be more significant. I see it as being a very unsettled period when actually companies with strong balance sheets don't just survive, they thrive. They can move into the markets vacated by some of the insolvents. If companies do go bust, as we saw with SVB UK, then just like HSBC, they can be bought for £1. I don't know how much that added to HSBC. It may have added 3 or 5 billion to their market cap. It was a very good acquisition. But they did start at 160 million market cap. So useful. But some of those opportunities for small companies to make transformational returns accelerate their earnings growth through a very unsettled period at a time when many mainstream companies aren't producing as much return, is one of the reasons why I think small caps are going to be superb investments through this uncertain period. Clearly, stock selection is going to be important. Lots of companies will fail. Lots of small companies and big companies may fail. But most particularly, I think the pattern changes there. And I think the opportunity for active managers, not just to preserve capital, but actually generate absolute returns, even at a time when perhaps the mainstream markets aren't rising much, is pretty exciting.
Yeah, some really important points in there. Thank you for that. Gervais, you've obviously run UK portfolios through a number of cycles over your career. I wondered if I could ask you. We talked a lot in this series about the UK valuations and whether it be outflows from UK funds or kind of relative valuations of the UK market. I wondered if I could ask you to kind of give it in your own words of the kind of opportunity that you see at the moment in the kind of context of history that we have in the UK at the moment.
Yes, I mean, what has been the feature really, particularly in the last 3 years, is we've seen a lot of redemptions. Particularly local wealth managers have often been withdrawing capital from the UK to put into bonds or possibly into international exchanges, possibly some of the better performing exchanges. And this has led to valuations of the UK market to be subnormal. Large companies have actually offset that by buying back quite a lot of shares. These are companies which they're already somewhat mature, so they generate surplus cash. They don't need more cash to run the businesses. They don't need to grow the dividends quite so fast. They can do some buybacks, etc. So the UK market's been under valuation pressure. But coming back to your question, Gordon, effectively, we are looking at small companies where they don't tend to buy back their shares. There have been ongoing sellers due to the redemptions of UK OICs. And so we've seen, particularly the AIM market, a terrible devaluation of ordinary quoted companies, even ordinary quoted companies which are continuing to succeed. Many of the companies which are growing their profits and such like have seen their share prices either not go up or go down, even when they succeed. And so we've got this massive mix change where the mainstream market's held up, but the AIM market, in say the FTSE or AIM All Share Index, has actually fallen about 50% relative over the last 3 years. The valuations were cheap before. In many cases, they're absurdly cheap at the moment. So coming back to it, I'm specifically to your question, right? I think, it's going to be a tough time. I think lots of companies are going to struggle. I think lots of stock markets going to struggle. I think lots of governments can run out of capital and struggle as well. So I think it's going to be a toughish time. Individuals will struggle if there's unemployment rising. So don't get me wrong, I'm not in any way viewing the future as a sunny uplands kind of period. But what I do think is that quoted companies will succeed. They have stronger balance sheets. They're less likely to go bust. Many of the companies who generate surplus cash don't just have surplus cash. They can expand into back-engaged markets. They can acquire assets with a pound from the receiver. But most particularly, you're starting at a valuation which is kind of extraordinary. That's not to say that there won't be some profit warnings and some setbacks going forward, but most particularly, some won't just succeed, they will succeed disproportionately. One of the wonderful things about small quoted companies, which is one of the reasons we've always had a bias towards them, is that sometimes when you get lucky, you can get very, very lucky. It's not just the company succeeds, but as it moves into market, as it becomes larger, as more investors suddenly become aware of it and research it, you find that actually the valuation of those stocks gets really accelerates up in this virtuous spiral, and you can generate what we could call an option value. It's a bit like you make 3 or 5 times your money rather than 30 or 50%. Coming back to your history and things, small cap effect is alive and well. It's not particularly obvious in the last 5 or 10 years, but it's alive and well. But most particularly for return. But most particularly, the small cap effect teaches us that the smaller the company, the better performance. And then within the UK market, it's not just we've got some quoted mainstream companies and some more caps and mid caps, but we've actually got some micro caps as well, where the option value can be extraordinary. I'm more bullish now about the opportunity to make a disproportionate return on smaller micro caps than I've been in my entire career. I am crazily optimistic. Now, don't get me wrong, as I remind you, I'm looking at a really range of very unsettled economic factors and corporate factors. So this is not from just being starry-eyed about it. But as an active manager, the current valuations, the current nature of the opportunity, the diverse income trust we think is superbly placed.
Yeah, no, that's very clear. Yeah, thank you for that. Gervais, we've got a standard closing question as well, and I hope it's not the trickiest. It sometimes strikes me as I'm asking kind of a favourite child question, but it asks the speaker for their kind of highest conviction area at the moment. I wondered if there was something you'd share there, whether it was a single company or an area of the portfolio. What would you choose if pushed?
Yes, I mean, what I would say is that I think that quite a lot of small project companies which are succeeding, aren't getting the credit for their success. And so, their highest conviction is it's UK small and micro caps as a starter 10. I won't recommend a stock in terms of buy this stock. But, it's not really about one stock. It's about the value and resistance. But if you look at the diverse income trust, one of the ones which sticks out as a slight sore thumb it is Concurrent Technologies. Not because it's a difficult company, or it's only just over 100 million market cap. It's involved in the defense industry. It's also involved in a couple of others. But it's involved in really putting Singapore computers into armored cars and that kind of thing. And actually, the US has standardized the kind of fittings. It used to be that each different tier one defense companies to have slightly different fittings. Now they've standardized that. So the opportunity for Concurrent Technologies to actually produce these boards to outcompete some of the local companies in that area is pretty exciting. We've had a management change. The management came in about 3 years ago. I think they're doing a terrific job. I think they've got loads of orders out there, which they could win. They may not win, but they've already announced quite a few. It's in the portfolio. It's already moved up quite a bit. It's just over 2% of the diverse income trust. It's not producing much income. It is producing some income, but not producing much. But the scope for that company to get a series of orders, the ability of that company to generate not just cash but abnormal surpluses of cash, the ability of that company to ultimately drive to good and growing dividends significantly is the reason it's in the portfolio. So I'm not recommending it as a stock. I'm just talking about it as the kind of nature of the option value we have within the portfolio.
Yeah, absolutely. Yeah, no, just a good example of the type of opportunity in the portfolio. Yeah, no, thank you for that. Gervais, it's always really nice to chat to you and get your thoughts. Thank you so much for joining us.
Thank you very much, Gordon. I've really enjoyed it.
Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com, for more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co is authorised and regulated by the Financial Conduct Authority, the FCA.